Welcome to the Techno Fundamental Report for March the 16th. I wanted to take a different approach this week. I've been thinking all week and examining the banking industry all week. As we all know, the banking industry is incredibly important, and we're having trouble here, so we want to take a look at it. But you can't make a silk purse out of a sow's ear, Jonathan Swift. If the banking industry is not doing well, it's not doing well, and we just have to kind of think about it. But, when it comes to investing, grit is having the courage to push through no matter what the obstacles are, because it's worth it. It's worth it to be an investor and take time. Now, one thing Peter Lynch talked about in his book that I thought was pretty good, he talks about something called a hit ratio, so that when you're building a stock portfolio, and you can't make any money. Now, a hit ratio is basically very simple. It's where you buy, say, 5 stocks, and you need to be making money on at least 3 of them before you move forward. So the hit ratio is important because as we've tried to get back into this market, we find it very frustrating, and we just can't seem to make money in the market. So the hit ratio is important. If you get to a situation where Peter Lynch basically says in the book, he says you cannot hit a hit ratio of 50% or more in a bear market. So if you're not able to hit a 50% hit ratio, you're probably in a bear market. So let's take a look at interest rates first, and then we'll take a quick snapshot of the market itself, meaning the stock market. But this is a indicator called the Power Index, and it was provided to me by my good friend Mike Centolo with Cabot Research. This indicator was very valuable decades ago because interest rates were a factor. Now realize that for the last decade, or actually almost 2 decades, interest rates have been incredibly low. So the problem has been that the banks have had a very low cost of deposits, a very low cost of funds. So as a result, we're now starting to see as interest rates move up, this is becoming a serious problem for them because their costs are going up. Now, this indicator, what we're doing here is we're taking the 5-year Treasury yield, which hit a high up here of over 4.3%, currently down to about 3.6%. Now, the rule is that if you go 125 trading days and you measure the rate of change, how much has the rate changed over the last 125 trading days? Well, one of the times we used that I'm aware of that this was a very successful indicator was back in 1987 when we had the crash of 87 in October of 87. And it was because the Fed started aggressively raising interest rates back in 87, and we had a dramatic drop in the stock market. It was substantial. So the rule is that if the rate of change over 125 days in the current situation, being that we've been above zero for an extended period of time because rates have been going up, if this crosses below zero, that is a signal that the Federal Reserve may stop raising interest rates or actually cutting rates, because with the banking situation, the Treasury is actually competing with the banks, because if you go to a bank, let's say in the last month or two, you would get a 3% CD, maybe a 2 to 3% CD, whereas the Treasury was paying, on the short-term Treasuries, 4 or 5%. So as a result, there's been somewhat of a run on the banks. And so one or two things got to happen here. One is that rates come down to the banks level, or the banks are going to have to raise what they're paying on CD rates in order to compete. But the problem there is they've got to have a solid loan portfolio to offset against it. In some of these banks, you have to realize some of these banks are more of a lending bank, where some banks act more as just a custodian of funds. Now, the ones that act like custodians of funds basically are investing in mortgages, and in some cases, long-term mortgages. And in the case of Silicon Valley Bank, that's what they were doing, and as a result, they had a run on the deposits, and they had to liquidate these mortgages at losses in order to pay the withdrawals. So optimistically speaking here, what this indicator is saying is the Fed may turn and change direction. Now, one of the things we're looking for in the market, and every market bottom of the last, say, 2 bear markets, which was let's take the '08 bear market, and we could take the bear market that happened because of COVID, or the pandemic bear market. This is the VIX. This is a volatility. This is what they call the fear index. It measures fear, and they use the options market to do it. So you can see here that these market bottoms, or these panics, you get readings on the VIX of up as high as 80, actually, above 50. And right now the VIX is at 26. So the reason I'm pointing this out is that every market bottom I've experienced, or major bear market I've experienced, had something to do with leverage, something to do with debt. So if we're in a situation where the banks are having a difficult time and we see a spike in the VIX, hopefully that means that the market has finally got a capitulation going and we're making a low. Now, just to talk briefly about the market itself, we're not getting any new highs, and we got to get new highs to get this thing going. There are just no new highs in the New York on the S&P. Then we look at the S&P again. We broke down below that 200-day moving average. So basically, the market is back in a downtrend. We're back in a downtrend. NASDAQ, pretty much the same thing. So this banking situation is really causing a lot of difficulties. Now, on the aggression index is where we're comparing technology stocks to consumer staples. You can see it's rallied, and we've seen some real improvement here. However, starting to soften up, and we kind of got what we would call a double bottom here. I would continue to keep an eye on the aggression index, which right now is telling you probably shouldn't be very aggressive here. Now, on the 10-year Treasury, these are our 3 economic indicators. There's a lot going on with these indicators. Right here, you see here where the 10-year Treasury is down to 3.4, and it's breaking below that 200-day moving average, which is kind of basically saying interest rates are going to start going down now. Now, the price of oil got below $70 a barrel. And, we've been talking about how oil's been in a downtrend. Well, it broke 70 yesterday. And then you can also see here, which we're going to talk a lot about, the financial stocks. Now, the financial stock, we break them down into 3 groups: banks, insurance companies, and brokerage firms. We're going to take a look at them here in a minute. Now, another indication of difficulties is the new lows. The new lows on the New York Stock Exchange have started to spike up again. Nothing as dramatic as what we've seen back here, but we're seeing more new lows than I would like to see, basically saying that the sellers are back. Now, this is a ETF. Now, take a minute here. The banks, you can analyze them fundamentally fairly easily. You can pull up their balance sheet, but the problem with fundamental analysis right now, in my opinion, is that all the data is coming as of 12/31/22. So you can get fourth quarter, but you're not able to get first quarter yet. And a lot has happened in the first quarter, meaning interest rates have gone up and we're starting to have these bank failures. Now, what I think makes a lot of sense is to try to look to the future. Now, we know about the market. The market discounts the future. So I would be looking at the stock prices is what I would be doing. Now, the S&P Regional Banking ETF, now this is not a normal decline. This is what we call a waterfall decline. So it's serious. It's not like, we're just drifting lower like right up here. You're just drifting lower. That's somewhat normal. But when you get into these catastrophic declines in the banking industry, that's real reason for concern. Now, here's Bank of America. So what we're going to do is we'll start off with some banks. Like this is a $228 billion bank. And look what's happening here. That is a waterfall decline. So that's Bank of America. Here we have First Horizon National Corp, which has a local presence here. So I have friends that have their deposits there, and they want me to analyze the bank. Well, it's an $8 billion bank, so it's fairly small. It's medium sized, put it that way. Again, you can see just this abnormal drop. So what What is the market discounting here? Is the market discounting that their investment portfolio is going to have problems, or is the market discounting that their loan portfolio? So, right now the problem is their investment portfolio. All these banks, it's all their investment portfolio because they're in these mortgages, and the interest rates are going up and the mortgages are going down. So the real question is, we roll into recession, are we then going to be looking at loan portfolios? That usually is the reason a bank has problems. Now here's Hartford Financial, which is, insurance. These are the people that sell annuities. These are the people that provide life insurance, so forth. That's somewhat of a waterfall decline there. So they have basically the same investment problem as the banks do because they're investing in these mortgages. Here's J.P. Morgan Chase. Now you can see here with this large bank. Now J.P. Morgan is, $377 billion bank, but their assets, are quite substantial. They're, a large bank. But you can kind of see here the market, the stock came down, stabilized. However, it is a little troubling that it broke that low yesterday, but it's holding above the 200 days. So a bank like J.P. Morgan seems to be holding up quite, relatively speaking, holding up better. So then we go to Regions Financial, which is kind of another. This is a $16 billion bank. Again, waterfall decline, somewhat of a rally, kind of stabilizing, not making a fresh low, but still a waterfall decline. Raymond James, brokerage firm. Let's take a look at that. That's an $18 billion company. Raymond James, again, somewhat of a waterfall decline. Here's Charles Schwab. Now, we've been talking to Charles Schwab and having correspondence with Charles Schwab. We feel very strongly that their liquidity position is quite strong. In fact, the CEO yesterday came out and said that they had $100 billion in liquidity. So there's been a flow of funds into Charles Schwab, but it still had the decline. However, it did rally, and maybe hopefully will be starting to stabilize in here. Here is Wells Fargo. Again, same story. Now, again, we have this problem where it came down and made a fresh low yesterday. And look at this volume. I mean, this is major selling. I mean, this is really major selling. So keep your powder dry. Stay conservative here. Be careful. I'm just letting you know that the market has turned back into a downtrend, and we need to just kind of keep an eye on things. Now, if you are interested in analyzing a bank and looking at their financials, feel free to email me or call me, because we the way we're doing it is we are looking at their investment portfolio relative to their net worth. That's a very important calculation. If you have any questions, please let me know.